Welcome to this explainer. Today, we're diving straight into the engine room of the procure-to-pay cycle. We're going to unpack the actual mechanics of P2P journal entries, and honestly, more importantly, we're going to uncover exactly where financial arrows just love to hide in plain sight. If you've ever wondered how purchasing directly impacts a business's financial reality before a single dollar even leaves the bank account, well, you're definitely in the right place. So let's just get right into it. We're breaking this whole complex process down into 4 logical steps. First, the accrual timing challenge. Second, bridging the gap. Third, looking at some alternate routes. And finally, stepping into the danger zone. All right, kicking things off with Section 1, the accrual timing challenge. Let's set the stage. Before we even think about looking at a single debit or credit, we really need to understand the golden rule governing everything we're talking about today, and that is accrual accounting. The core principle here is that we have to recognize a cost and a liability exactly when the economic event actually happens. That means the moment the goods hit your loading dock or right when your team consumes a service. We absolutely do not wait for the supplier's invoice to show up in the mail, and we definitely don't wait until the cash is paid out. It's all about tracking economic reality as it happens. But that creates our main headache. It's a literal physical timing gap. Say on day 1, the goods arrive. The business has officially received value. But maybe that invoice doesn't actually show up until day 15. And the cash payment? That might not happen until day 45. So how in the world does the accounting system accurately reflect that we have these goods on day 1 when we don't even have a bill to process yet? Well, that brings us perfectly to Section 2, bridging the gap with the GR&I count. To cross that physical timing gap we just talked about, we basically have to build a metaphorical bridge. Picture this: the delivery truck backs up, the boxes are sitting right there in the warehouse, and a goods receipt note, or a GRN, gets raised in the system. The goods are here, but no invoice. Because of accrual accounting, we can't just sit on our hands. The business received value, so we owe money. And boom, that triggers our very first critical journal entry. What's really cool about this entry is just how elegantly it solves our whole timing issue. We debit inventory or expense, depending on what it is we actually bought, because we now physically possess that value. But what about the credit? We credit an account called Goods Received Not Invoiced, or GR&I for short. This GR&I account acts as our temporary bridging liability. It officially records the obligation to pay, essentially holding the space while the official supplier invoice is missing in action. Fast forward maybe a couple of weeks. That supplier invoice finally lands on your desk. Your accounts payable team matches it up against the purchase order and the goods receipt note, doing that classic 3-way match. Now that we finally have the official legal document demanding payment, we don't need our temporary bridge anymore. It's time to dismantle it. So to dismantle it, we just debit the GR&I account. That completely clears out the GR&I balance. Gone. Zero. And simultaneously, we credit accounts payable. We've officially moved our obligation from this temporary, uninvoiced holding area straight into the formal, permanent AP subledger. The bridge did its job. Then, of course, the due date rolls around. The authorized payment run executes, we clear out that formal accounts payable liability with a debit, and we credit cash, reflecting the money actually leaving the business. And that right there completes the standard accounting life cycle for an individual invoice. The value was tracked flawlessly from the loading dock all the way to the bank transfer. But hey, accounting isn't always a perfectly straight line, right? Let's move to Section 3, exceptions and alternate routes. The most common exception you'll see is this. What happens if the invoice arrives, but there's absolutely no prior goods receipt note in the system? It happens all the time. If you're buying intangible services, say consulting or maybe a software subscription, or if the invoice literally arrives in the exact same box as the physical goods, well, there's no timing gap to bridge. In that scenario, we completely bypass the GR&I bridge. We go straight to accounts payable. We debit inventory for stock, expense for services, or fixed asset for capital purchases, which recognizes the cost immediately. Then we just credit accounts payable directly. We're recognizing the cost and the formal liability all at once in one clean entry. Oh, and here's another really great alternate route. Let's say your supplier offers a 2% discount if you pay early, say within 10 days, and you decide to take that shortcut. When you make the payment, you debit accounts payable for the full original invoice amount to entirely clear out that liability. But you only credit cash for the net amount you actually paid out. That difference, the 2% you just saved, gets credited to a purchase discount or finance income account. It's a fantastic setup because it gives management crystal clear visibility into exactly how much money the business is saving by jumping on those early payment discounts. All right, now we're entering the final and honestly probably the most critical phase of this explainer. Section 4, the danger zone, unmanaged GR&I. We really need to talk about what happens when our temporary bridge turns into a permanent trap. Think about the period end close. It's the end of the month, and you've got GRNs in the system where the goods arrived, but the invoice is still nowhere to be found. To make sure expenses are recognized in the correct period for your financial reporting, you have to post an accrual entry. Debit expense, credit accrued expenses. But here is the absolutely crucial part. You must manually reverse this specific accrual at the very start of the next period. Why? Because when that invoice finally does arrive next month, it's going to be processed normally. If you forget to reverse that period end accrual, you're literally going to end up counting the exact same expense twice. You have to remember, GR&I is meant to be a temporary clearing account. It's supposed to zero out. So if you're looking at a massive or constantly growing GR&I balance, major alarm bells should be ringing. It almost always points to one of 3 operational failures. 1. Your warehouse is raising GRNs for goods that haven't actually hit the dock yet. 2. Invoices are getting lost in the mail or buried in an inbox and just aren't being matched up promptly. Or 3. Your finance team is simply skipping their mandatory period-end GR&I reviews. And if you skip managing this, you're not just making some minor bookkeeping typo, you are actively misstating your company's financial reality. Let's look at the actual consequences here. In scenario A, if you fail to raise your period-end accrual for those unmatched goods, your expenses are artificially understated. That means your profit looks falsely inflated to your investors and management. Not good. But in scenario B, let's say you do raise the accrual, but you never investigate and clear out the old, stuck GR&I balances. Well, now you're double counting your liabilities, making the whole company look like it's drowning in debt that doesn't even exist. It's exactly like the source material states. The GR&I account is where accounting errors hide. It really is the dark corner of the procure-to-pay cycle. So as you gear up for your next period-end close, I want to leave you with this to chew on. Are you actively inspecting your GR&I bridge to make sure value is actually flowing smoothly across it? Or are you just letting the errors quietly pile up in the dark? Definitely something to think about the next time you review that balance sheet.